Hi, I'm Matt Atwood, one of the advisors here at Timewise, and today I want to talk to you about investing. We are going to address a few questions a lot of people have had, whether they are just getting started or lifelong investors. Our goal is to answer tough questions like, what should people know before they get started? How can someone get started investing? And how often should you rebalance your portfolio? With that being said, let's jump right in. So what should people know before investing? Well, first, investing can be very risky. Often people are not aware of the inherent risk when they buy shares in the stock market. You can research terms like beta and standard deviation, but typically at the end of the day, the more a stock swings up or down, the more risk those shares have. While swings upward feel great, you must be able to stomach those swings downward as well. Therefore, if you're going to do a high-risk trading strategy, I would recommend only investing what you can afford to lose. Additionally, it's important to point out that wealth is not created overnight. Investing is a long-term sport. And when we wake up each day, the news of the globe shapes how the quote-unquote market performs. Share prices can swing wildly in one direction or another based on the sentiment towards that company on any particular day. It is essentially a coin toss prediction on a day-to-day basis if things will be up or down, as no one can predict what news may come and how that news will be interpreted by irrational investors. This makes it extremely hard to quote-unquote time the market swings and make a profit over the short run due to that unpredictable nature of both the news and the markets. Though history shows us over the long run, profitable companies go up in value, which makes performance more predictable for those profitable companies over the long run. It is best to invest funds that you will not need for a long time, so that they have a higher probability of going up in value and not being affected by those negative potential news stories in the short run. Lastly, what are you buying anyway? Well, when you buy stock, you're buying stake in a company. You now own equity in that company. And if things go well, your equity increases, just like the value in your home increases if you have a good investment. But if things go poorly, you are also on the hook. If we think about the stock like equity in our home, we want to be selective in what we buy. A house that is falling down, overrun with termites, and let's say right next to the former site of Chernobyl, may not be nearly as attractive as a house with all the newest furnishings in a nice part of town. This works the same with companies. You need to determine if you are buying a great piece of property, a fixer-upper, or a lost cause. Additionally, it is always nice to have multiple different independent revenue streams. This means that most would prefer to invest in a few different industries to diversify their income, as opposed to just one particular company. If you were to put all your money into one favorite airliner, and then let's say, speaking hypothetically of course, a global pandemic came around and halted all travel, you will take a huge hit. Instead though, if you had a little bit of money in an airliner, a little bit of money in a pharmaceutical company, and a little bit of money in a little tech chip manufacturer, you would lose some money on that airline investment, but you'd make money on those other companies and everything would even out over the long time, even when times get tough. Next, let's talk about how do you even get started investing. Well, your size and scale determines how tailored of an approach you should take. In the beginning, it may be best to start online with one of the many online brokerage firms. These companies make opening an account a breeze. As you accumulate more wealth though, and therefore more taxes, there may come a time when a more tailored approach from a financial professional is beneficial. If you are nervous about losing money, many online brokers offer what they call quote-unquote paper trading, where you can practice trading with fake money. It's similar to a simulator, and this allows you to test your trading strategies and learn the ins and outs before you have any real skin in the game. Finally, how often should someone rebalance their portfolio? Well, we'll say at least annually, but often quarterly depending on the sizes of your account and the sizes of the swings in the previous quarter. If one part of your portfolio does really well in one quarter, it may grow to be a large percentage of your account. This may be a good time to lock in some gains and get your account back to a balance that you're more comfortable with. So, what are the next steps? Either engage a financial professional or open an account and begin trading. Individuals have more access to wealth building professionals and markets than ever before. That being said, if you have questions or are ready to get started, check out our website and give us a call. And if you like this video, be sure to subscribe to our YouTube channel. Thank you for joining us, and look out for more great content on how to add purpose to your wealth planning process.